Meanwhile, the global banking crisis looks like it's here to stay. Another big name is making news. We're talking about Deutsche Bank. Its shares fell sharply last week. They dropped by more than 14% on Friday. There was panic, so much so that German Chancellor Olaf Scholz had to try to calm nerves.
Deutsche Bank has thoroughly reorganized and modernized its business model and is a very profitable bank. There is no reason for concern whatsoever.
No reason to be concerned. That is the message from Germany. But if that's the case, why are investors dumping shares? Is Deutsche Bank the next Credit Suisse? We'll try to answer that tonight. First things first, it's much healthier, this bank. Fundamentally, there is no problem with the bank. Deutsche Bank is well capitalized, meaning it has enough cash to sustain itself. So why is the share price falling? The fall in the value of the bank's stock is mainly due to investor panic. You can blame it on baggage of the past. The bank has seen major financial challenges before. In fact, before the 2008 crisis, this bank tried to compete with the giants from Wall Street. It also led to a flurry of scandals. There were misconduct and compliance cases and losses worth billions of euros. A few years back, the International Monetary Fund called Deutsche Bank the riskiest bank in the world. But since then, a lot has changed. The bank launched a major restructuring plan. It cut thousands of jobs. It focused its business on Europe and managed to restore its financial health. In 2022, Deutsche Bank booked its highest annual profit since 2007. So why is the share price falling? Mostly thanks to the ghosts of the past, also because of the general sentiment. You see, this month, 2 American banks failed. The world saw turbulence. Investors began reviewing their portfolios. They were on the lookout for the next weak link, the next bank that could face a crisis. And Deutsche Bank took the brunt of it.
So a virus of insecurity is planted relatively quickly and then lasts for a very long time. The uncertainties about the banking system and the loan defaults, the risks in the banks can be felt everywhere in the market. But that doesn't really change the fact that they are special cases that have ultimately caused the entire banking system to be thrown into disrepute and uncertainty.
Uncertainty. That's what it is. And it's not going away in a hurry. Today, the Silicon Valley Bank was acquired. It has been bought by First Citizens. That's a bank from North Carolina in the US. Remember, Silicon Valley is where the crisis began. It was the first bank to fall. It is the go-to bank for the tech sector in the US. It collapsed on the 10th of March. There was a bank run. Almost 3 weeks later, the bank has been bought out. It was inevitable. The bank was seized by regulators. An acquisition is expected to restore its health. And what's the deal here? What's in it for First Citizens, the bank that is buying it? It will get a large chunk of SVB's assets. They're worth $72 billion. First Citizens is buying them at a discount of $16.5 billion. But the big picture still remains negative. American citizens do not trust banks. This is according to the findings of a new poll. It was conducted by the Associated Press. The poll says only 10% of adults in the US have quote-unquote high confidence in American banks, and 31% hardly have any confidence. The conclusion is this: America needs to do more to regulate its banks.
Even though most Americans have at least some confidence in banks, the poll shows a majority say they want to see the US government do more to regulate banks and other financial institutions. And that concern about underregulation is bipartisan. It's a majority of Democrats and half of Republicans who say they want to see the government do more to regulate banks and other institutions.
What's happening with American banks is worrying. Even the IMF, the International Monetary Fund, has called for more vigilance. The managing director of the IMF has appointed assessment. She says the global economy faces risks. Rising interest rates put pressure on debts. And this has led to stresses on leading economies.
As we have seen in recent developments in the banking sector in some advanced economies. But we also have seen policymakers acting decisively in response to financial stability risks, and we have seen advanced economy central banks enhancing the provision of US dollar liquidity. These actions have eased market stress to some extent, but uncertainty is high, and that underscores the need for vigilance.
These comments are stark. The IMF MD has joined other economic leaders in sounding an alarm. Last week, the European Central Bank said the same thing. It said the turmoil in the banking sector will hurt business and growth. Where does all of this leave India? Not in the zone of immediate risk, but at a point where you have to up your guard. India's Finance Minister Nirmala Sitharaman has said that she is reviewing the performance of public sector banks. She has issued specific instructions. She wants banks to undertake, quote-unquote, regular stress tests. Given the global environment, it's best to be cautious than sorry.